Silver futures on COMEX trade at $56 per ounce, but physical dealers quote premiums exceeding 25% for immediate delivery. Backwardation has widened to nearly $3 between spot and front-month contracts. LBMA vaults shipped 58 million ounces to COMEX in October alone, yet eligible inventories hover at critical lows, down 40% year over year. This isn't volatility. This is fracture. The system's plumbing failed when CME halted trading on November 28 as silver pierced $54, only to resume and watch it surge past $56. Banks triggered their kill switch, overnight margin hikes of 10% on December 11th, and it backfired. Physical buyers absorbed the dump, leaving paper shorts exposed. The divergence accelerates now in real time as Eastern demand drains what's left. I see this not as a market event, but as a systemic signal. The paper mechanism that once anchored silver's price to institutional control is decoupling. Consider the mechanics. Bullion banks like JP Morgan and UBS have held dominant short positions, often exceeding 60 billion ounces equivalent in futures, without matching physical backing. These aren't hedges, they're suppression tools. When silver threatened a breakout above $50 earlier this year, morning tamps, coordinated sells between 8:30 and 11 a.m. EST, slammed it back as they've done for years. But in 2025, the pattern broke. Physical inflows to Shanghai hit their highest weekly levels in 18 months, while India pulled in 1,600 tons in November alone. That's not speculation. That's industrial and sovereign hoarding pulling metal out of Western vaults. The kill switch, meant to force liquidation and crush leverage, instead revealed the bluff. Margin nukes raised costs by 50% overnight in some cases, yet longs held, and spot refused to follow futures down. Here's where the logic snaps. If supply were ample, why the emergency halts? Why reposition market makers to avoid off-the-charts prints? This fracture mirrors deeper instability, the kind that history exposes when trust in paper erodes. Look back to Byzantium, where the solidus, once the gold standard of Mediterranean trade, lost its purity as emperors debased it with alloys. Merchants didn't notice at first, but as confidence waned, real value fled to untainted assets. Byzantines who clung to state promises watched their economy crumble, while those who shifted to land or pure metal preserved wealth. Fast forward to today. Silver's paper price is the modern solidus, diluted by endless futures contracts untethered from vaults. COMEX's eligible stockpiles claim hundreds of millions of ounces, but much is pledged, leased, or phantom, rehypothecated across chains. When a rumored 400 million ounce delivery demand surfaced from China, exchanges pulled plugs rather than default. That's not resilience, that's evasion. The system's stability hinged on infinite paper absorption, but physical scarcity now enforces limits. If you've tracked Eastern metal flows or seen inventory draws firsthand, share how this divergence plays out in your corner of the market. Your observations could clarify where the next break hits. The consequences unfold asymmetrically, just as they did during the Black Death in 1347. Half of Europe vanished, but survivors found labor scarce and land abundant. Wages surged. Abandoned properties sold for fractions. Those with liquidity, coin, goods, skills, acquired assets that propelled generational wealth. Contrast that with the trapped, wage earners living hand-to-mouth, erased by the shock. Silver's current squeeze echoes this redistribution. Industrial users in solar, electronics, and defense face premiums spiking 30% above spot, forcing production halts or frantic sourcing. Meanwhile, institutions like Samsung trigger supply alerts, pulling metal offline. The kill switch failure amplified this. When CME's technical glitch nuked $1 off spot in minutes on November 28th, it wasn't coincidence. It was intervention to suppress breakout. But physical held firm, backwardation deepened, and price rebounded harder. This transfers control from paper manipulators to real holders. Banks, knee-deep in shorts, now face mark-to-market losses in the billions as silver tests $59 highs. The unprepared, leveraged speculators get liquidated, while sovereign buyers accumulate at scale. It's not growth, it's rupture. Geopolitics interlaces here, tightening the noose. Western sanctions and tariffs disrupted supply chains, but Eastern pivots accelerated drains. India's tariff impacts created volatility windows that banks exploited for tamps, yet demand overwhelmed them. J.P. Morgan's quiet relocation of its precious metals desk to Singapore signals retreat, closer to physical demand hubs, away from COMEX scrutiny. This isn't expansion, it's repositioning for bilateral deals as Western paper loses grip. Recall the Asian financial crisis of 1997. Thailand's baht peg shattered under speculative attacks, devaluing currencies across the region. Locals with dollar debts drowned, while foreign institutions scooped assets cheaply. Silver's set up parallels. Banks' short exposures are the modern foreign debt. Leveraged bets, assuming endless control. But as physical shortages bite, those positions become unpayable. The 300 million-ounce annual deficit UBS now admits isn't theoretical. It's manifesting in LBMA's float exhaustion, forcing COMEX bailouts. Regulators' silence amplifies the signal. No probes into halts or margin spikes, just quiet rule tweaks. If you're in trading or policy circles, how do you read this regulatory void? Drop your take in the comments. It might reveal the next institutional move. Push deeper, and the military-industrial angle emerges, where silver's role exposes vulnerability. Beyond investment, it's critical for munitions, electronics, and renewables, sectors where stockpiles can't be faked. U.S. defense draws have quietly accelerated, yet public inventories mask the strain. Historical wars underscore this. During the American Civil War, Confederate graybacks inflated thousands of percent as printing outran value. Soldiers' pay bought nothing. Families bartered real goods. Union greenbacks fared better, but still eroded trust. Survivors held land, food, or metal, untouchable by presses. Silver today stands as that untouchable asset amid fiat floods. Banks' manipulation, spoofing convictions at JPM in 2020, settlements at Deutsche in 2016, proves intent, yet tactics persist. The kill switch, like Civil War overprinting, aimed to flood paper and dilute price. It failed because physical demand, driven by geopolitical hoarding, absorbed it. Miners lagged the metal's rise, trading at discounts to net asset values, signaling underappreciation of profits ahead. This disconnect won't hold. When funds rotate in, the re-rating crushes shorts further. The Florence banking collapse of the 1340s layers another warning. Families like Bardi and Peruzzi, Europe's financiers, loaned massively to kings like Edward III, who defaulted. Banks folded, depositors lost everything, trade halted. Too big to fail proved illusionary, as it did with Lehman in 2008 or Lebanese banks in 2019 freezing accounts. Silver's banks, JPM, HSBC, Scotiabank, echo this hubris, holding shorts without full backing, assuming systemic rescues. But as vaults empty and deliveries falter, the illusion cracks. Lebanon showed, savings froze, currency plunged 90%, yet those with offshore assets or physical endured. Silver's premium surge is that freeze in motion. Access tightening as paper promises hollow out. If you've navigated similar asset freezes or seen bank runs up close, weigh in on how silver's physical edge compares. Your experiences could sharpen this analysis. French Revolution's assignats drive the point home. Backed by seized church lands, they seemed solid until overprinting exploded prices. Peasants rejected paper for barter. Riots followed. Winners held food, gold, property. Real over promises. Silver's industrial backbone mimics this. Solar panels need 20 million ounces annually. Defense more, yet mining output stagnates at 800 million ounces globally, with deficits compounding. Banks' tamps kept prices low to mask this, encouraging consumption over hoarding. The kill switch backfire reversed it. Post-halt, silver miners' implied profits soared, yet stocks haven't caught up, creating arbitrage for the alert. Geopolitical threads weave in. Russia's pivot to metal reserves, China's stockpiling, eroding dollar hegemony. This isn't isolated. It's the fiat system's edge fraying, where silver's dual role as money and material forces exposure. Rome's denarius debasement set the template. Emperors clipped silver content. Inflation followed. Trust vanished. Those who doubted early shifted to gold or land. Silver's 2025 story flips it. Banks debase paper silver via futures floods, but physical purity endures. The Hunt brothers' 1980 squeeze foreshadowed. As they cornered, COMEX changed rules mid-game. Liquidation only, margin spikes, to crash price from $50 to $10. Echoes in today's overnight hikes, not to stabilize, but to protect shorts. Yet unlike 1980, physical demand now dominates, from India's record imports to Shanghai's surges. The failure here is structural. Paper can't outrun atoms forever. If historical squeezes like this resonate with your market views, share your interpretation in the comments. Differing lenses often uncover hidden fractures. Lebanon's 2019 freeze crystallizes the endgame. Banks locked doors, pounds lost 90%, savers queued for scraps. Survivors diversified offshore or into tangibles. Silver's vaults mimic those doors. LBMA's crisis in September-October drained floats, prompting COMEX airlifts. But airlifts delay, don't solve. The system's loss of control manifests in spreads. Futures decouple from spot. Volatility spikes without resolution. Miners, undervalued amid record margins, position as the next beneficiary. This isn't hype. It's observation of mechanics failing where they once dominated. The process advances without reversal. Paper suppression bought time, but physical reality enforces boundaries now. Banks repositioning, desks to Asia, bullish calls from former shorts, signals capitulation. Deficits compound, premiums persist, divergences widen. History's pattern holds. From debased coins to frozen accounts, value migrates to the undebasable. Silver, at this juncture, embodies that migration. The kill switch triggered exposure, not containment. The fracture deepens. Spot silver pierced $66 per ounce on December 17th, while COMEX front-month futures lagged by over $4 in persistent backwardation. Physical premiums at major dealers exceeded 30% for 1,000-ounce bars, with delivery delays stretching weeks. Registered COMEX inventories dipped below 100 million ounces for the first time since the COVID squeeze, down 70% from 2020 peaks. LBMA vaults reported outflows exceeding 50 million ounces in the past quarter alone, despite record nominal holdings. CME imposed a 10% margin hike on December 11th, raising initial requirements to $22,000 per contract. Yet open interest held, and price rebounded harder. This isn't correction. This is rupture. The paper anchor snapped under physical weight, and the divergence widens daily. The mechanics expose themselves plainly now. Bullion banks maintained short exposures equivalent to years of global mine output, assuming perpetual rollover and manageable delivery claims. J.P. Morgan alone flipped from a rumored 200 million-ounce net short to accumulating physical stockpiles exceeding 750 million ounces by October, relocating its precious metals desk to Singapore for proximity to Asian flows. That's not hedging, that's exodus. When the exchange halted trading for hours on November 28th, amid a data center issue, orders vanished and spot plunged briefly, only for physical bids to refill the gap instantly. Backwardation flipped deeper, EFP spreads collapsed to pennies, signaling buyers pay anything for immediate metal over paper promises. Industrial users, solar manufacturers quoting 40% premiums, electronics firms issuing supply alerts, absorbed the volatility without retreat. The kill switch, deployed through margin spikes and rule tweaks, forced speculative liquidation but left core demand intact. Shorts covered at losses, physical drained faster. History reflects this breakage clearly. In 1980, the Hunt brothers cornered supply until COMEX imposed liquidation-only rules and margin explosions, crashing price from $50 to $10 overnight. Banks survived then because physical demand lacked today's scale. Solar consumed negligible ounces. EVs didn't exist. Today, annual industrial offtake approaches 700 million ounces, with solar alone projected at 260 million in 2025 despite thrifting efforts. Mining output stagnates near 800 million ounces globally. Recycling adds marginal buffers, yet deficits compound yearly. The 1980 intervention worked because the squeeze was speculative. 2025's is structural. Regulators watch silently as inventories approach critical thresholds, echoing Florence's 1340s banking cascade, where overextended lenders to kings defaulted, wiping depositors while trade froze. Modern equivalents, concentrated shorts without full backing, face the same arithmetic when delivery notices exceed movable metal. Geopolitical layers accelerate the drain. India's imports surged past 2,600 tons in September-October alone, driven by solar deployment and investment ETFs tripling inflows. China's stockpiles hit decade lows, with export curbs looming January 2026, redirecting domestic supply inward. Western vaults airlifted metal eastward earlier this year. Flows now reverse sporadically, but constraints bind. Defense applications, munitions guidance, radar systems draw quietly from strategic reserves, unpriced in public data. This mirrors the Confederate grayback's hyperinflation, printing flooded paper while real goods retained value. Today's paper silver floods via futures creation, but atoms resist dilution. When lease rates spiked to 40% in October, London borrowed frantically from COMEX, temporary relief that exposed the chain's fragility. If you've dealt with regional supply chains or seen these premiums firsthand, describe how the tightness manifests in your operations. Those details often reveal the next pressure point. Deeper still, the monetary dimension surfaces. Silver's dual role, as industrial input and historical money, amplifies stress when fiat systems strain. Post-2008 quantitative easing eroded trust gradually. 2025's rally, up 130% year-to-date, reflects flight alongside industrial pull. Byzantine emperors debased the solidus incrementally until merchants rejected it for purer alternatives. Paper silver's endless issuance achieved similar dilution until physical scarcity enforced recalibration. French assignats collapsed under overprinting. Peasants bartered goods as paper vanished. Today's margin hikes and halts resemble those desperate measures. Buying time, not restoring equilibrium. Banks like J.P. Morgan, once dominant shorts, now hoard physical, signaling internal recognition that control slipped. Their Singapore pivot aligns desks with demand centers, away from Western oversight. This isn't coincidence. It's adaptation to a market where paper no longer dictates terms. The asymmetry intensifies consequences. Industrial fabricators face rationing. Solar installations delay. EV production throttles components. Data centers postpone expansions. Premiums compound costs, inflating end products subtly. Meanwhile, holders of physical command scarcity rents, echoing Black Death survivors acquiring land cheaply amid depopulation. Those with liquidity then built wealth. Today's equivalents accumulate metal as vaults empty. Speculative shorts, leveraged 20-to-1, bleed from mark to market, while core buyers, sovereigns, corporates, stand for delivery. COMEX-registered stocks, the deliverable portion, hover critically low relative to open interest, risking stand-for-delivery cascades. Asian financial crisis parallels emerge. Dollar debts became unpayable as pegs broke. Here, short obligations grow insurmountable as spot decouples upward. If you're tracking institutional positioning or CFTC data shifts, share your read on where the covering pressure builds next. It could pinpoint the acceleration phase. Push further, and the systemic vulnerability clarifies. Silver threads critical technologies. Photovoltaics needing irreplaceable conductivity. 5G infrastructure demanding thermal properties. AI servers requiring efficient power distribution. Substitution thresholds sit far higher. Prices must quadruple before alternatives compete economically. This locks demand even as costs rise, contrasting jewelry's price sensitivity. Miners, trading at discounts to surging cash flows, lag the metal's re-rating, arbitrage for patient capital, but signaling underinvestment in supply response. Historical wars consumed silver voraciously. Modern equivalents in renewables and defense draw steadily, invisibly. Lebanese banks freezing accounts in 2019 showed institutional promises hold until they don't. Silver's physical edge then preserved value. Today's vault drains mimic that gate closing in slow motion. Access tightens gradually, then suddenly. The process compounds without counterforce. Margin adjustments raised carrying costs 10%, yet volatility persisted, drawing more intervention signals. Trading volumes shattered records post-halt, dominated by physical conversions. Eastern exchanges, Shanghai, India, absorb flows as Western paper credibility wanes. China's restrictions foreshadow tighter global float. India's hoarding accelerates it. Banks' bullish revisions, former shorts forecasting $60 plus, confirm capitulation. This mirrors Roman denarius clipping, gradual debasement until confidence evaporated, value fleeing to untouchable assets. Silver embodies that refuge now, its scarcity enforced by industrial necessity rather than decree. Scale emerges unrelentingly. Cumulative deficits since 2019 exceed 1 billion ounces. 2025's alone approaches 200 million. Inventories buffer temporarily, but depletion rates quicken. Premiums persist across forms, coins, bars, grain, indicating broad tightness, not localized anomaly. Regulators in action, absent probes into halts, margins, concentrations, stands as its own indictment. History's collapses rarely announced themselves loudly. They eroded quietly until thresholds crossed. Silver's fracture advances past that point. Paper mechanisms designed for control now amplify exposure. Physical reality reasserts boundaries. The divergence endures. The transfer continues, from leveraged promises to tangible atoms, from manipulators to holders, from illusion to constraint. The system lost its grip. Spot silver closed at $66.52 on December 17th, with physical premiums holding above 25% for bars and coins amid delivery queues extending into January. COMEX registered stocks fell another 15 million ounces in the past week, pushing deliverable inventories below 80 million ounces, levels not seen outside crisis periods. CME's December 11th margin hike to $22,000 per contract triggered forced covering, yet open interest rebounded as new longs entered. Backwardation persists at $4 between spot and March futures, the widest since the 1980 squeeze. LBMA vaults reported modest inflows in November, but the float remains depleted after earlier drains exceeding 100 million ounces year-to-date. This isn't stabilization, this is escalation. The paper system's repeated interventions, halts, hikes, glitches, failed to contain physical withdrawal, exposing the mechanism's limits in real time. The reversal accelerates visibly. JP Morgan, long the dominant short, with exposures once equivalent to 200 million ounces naked, closed that position entirely between June and October, while accumulating over 750 million ounces physical, the largest single hoard globally. Their Singapore desk relocation places traders' steps from Shanghai and Indian flows, optimizing for bilateral physical deals outside Western oversight. This flip removed the primary damper on price for over a decade, the entity most capable of coordinated tamps now profiting from ascent. When former suppressors become the biggest holders, the old equilibrium dies. Industrial users face the fallout directly. Solar fabricators ration allocations, EV supply chains issue force majeure notices, data center expansions delay over component shortages. Annual offtake approaches 700 million ounces, mining flat at 800 million. Deficits embedded structurally. The margin spike, framed as volatility management, instead amplified covering as leveraged shorts bled, while sovereign and corporate buyers stood firm. History illuminates the breakpoint. The Hunt squeeze of 1980 saw COMEX impose liquidation-only rules and margin explosions to protect concentrated shorts, crashing price from $50 to $10. But demand then was speculative. Today's is inexhaustible industrial plus strategic hoarding. Rome clipped denarius silver content gradually until armies rejected pay, value fleeing to purer forms. Paper silver's fractional backing achieved analogous dilution until atoms reasserted scarcity. Byzantine solidus debasement eroded trust incrementally. Merchants shifted to land or gold as confidence collapsed. Today's banks, facing mark-to-market on unbacked shorts, pivot quietly. Desks to Asia. Forecasts revised to $70 plus. The kill switch backfired because physical reality imposes non-negotiable boundaries. If you've observed similar institutional repositioning in past cycles or track CFTC shifts closely, share your assessment of how far this covering extends. Those patterns often forecast the intensity ahead. Consequences compound across sectors. Defense contractors draw unpublicized stockpiles for guidance systems and radar. Renewables throttle growth projections as premiums inflate project costs 15 to 20%. Miners, flush with margins, yet trading at discounts to cash flows, await fund rotation, the laggard leg that historically amplifies moves. Geopolitical tariffs and export curbs tighten the global float further. China's impending restrictions redirect domestic output inward. India's record imports persist seasonally. This echoes the Asian crisis. Pegs shattered, debts unpayable, assets transferred cheaply to outsiders. Here, short obligations grow toxic as spot decouples. Banks' exposures the modern unpayable debt. Lebanese freezes showed institutional gates close suddenly. Silver's vault drains enact that gradually. Access erodes, then vanishes for the unprepared. The monetary thread tightens inexorably. Fiat erosion, trillions printed post-crisis, rates manipulated, drove flight to hard assets. Silver's affordability amplifying inflows versus gold. ETF holdings swelled 18% year-to-date, locking metal offline. French assignats overprinted until peasants bartered goods. Confederate graybacks inflated thousands percent as presses outran value. Survivors held real goods, land, metal. Silver's dual necessity, industrial irreplaceable, monetary undebasable, positions it as the modern refuge when paper promises hollow. Banks' interventions bought decades, but structural deficits and demand surges enforce recalibration now. If industrial contacts reveal rationing severity or premium trends in your region, detail it here. Granular views often expose the fracture's depth before aggregates reflect it. Scale crystallizes coldly. Cumulative deficits since 2020 exceed 2 billion ounces. 2025's alone nears 150 million despite thrifting. Premiums embed across forms, backwardation entrenches. Interventions multiply without reversal. Regulators' absence, silent on concentrations, halts, hikes, signals acceptance of the shift. History's debasements rarely reversed. Value migrated permanently to the untouchable. Silver's rally, 130% year-to-date to record highs, manifests that migration. Former manipulators hoard. Physical drains accelerate. Paper loses anchorage. The kill switch exposed the bluff. The system fractured under its own weight. Physical enforces the boundary. The transfer from diluted promises to scarce atoms, from controllers to holders, advances irreversibly. The process deepens. The divergence endures.